Right, I see that is 11 o'clock, so good morning, good early afternoon. I know everyone is very busy, so if you have someone who registered but could not attend, I will send the slides out to all of the individuals who registered, and we will also post this on our town benefits website. I call this 1094 and 1095C reporting for 2025 and how to avoid common errors, because there are some things that I see regularly with the 1094 and 1095C forms, simply because they're so complicated to fill out, and just putting the wrong word or not completing something properly can have a negative impact on your filing. So let's go ahead and get into it. My name is Corbin Granger. I'm the Senior Vice President of Compliance here at Town Benefits. So as you know, I am not an attorney, nor am I a CPA. This information is based on current IRS, HHS, and other guidance, so it is always subject to change. Also in this webinar, I don't cover additional ACA reporting requirements for companies, or excuse me, for states that have individual mandate penalties, such as California, New Jersey, Rhode Island, Massachusetts, Washington, D.C., and Vermont, though Vermont has no financial penalty attached to it. So if you do have a specific question, I encourage you to speak with your attorney or lawyer regarding some of those tax issues. So for 2025, we have really, the forms have not changed much except for the date of the year. And in 2025, you are supposed to distribute the 1095C form to individuals by March 2nd, 2026. However, there is an alternate method of furnishing 1095Cs that is now available, and I will go over that on the next slide. Nonetheless, even if you use that alternative method, you do need, as an employer, to file the 1094 and 1095C forms electronically by March 31st, 2026. The IRS will no longer accept paper returns unless a company has fewer than 10 total tax returns. So basically, everyone files electronically. So what is the alternative furnishing of the 1095 mean? Well, prior to 2024, an applicable large employer was required to furnish a 1095C to all full-time employees. That's much like a W-2. Now the IRS has rescinded that requirement and says, you know what, employer, you do not have to automatically mail or distribute these as long as you do certain things. First, you have to put a clear, conspicuous notice, something that's readily accessible by all covered individuals on your website by March 2nd. You also must keep that notice on the website until October 15th. And if you get a request, you provide it by the later of January 31st or 30 days after the request from an employee. Now, these tax forms are no longer needed for filing an individual's income tax return. So should you not want to mail or give these out, you just have to keep one. You have to keep record of them. So if someone requests it, and there's always someone who will request it, and provide it to them. And as I mentioned, everything still must be filed electronically. So we're going to go into each penalty a little separately and show you how the penalty interacts with the form. So the nuclear penalty we call is attached to the 1094C, because the 1094C reports if the employer offered coverage at all, or at least offered what we call minimum essential coverage, which is the lowest bar of coverage, to 95% of full-time employees and dependents. So if an employer doesn't offer coverage at all or fails to offer minimum essential to 95% of full-time and employees, they could face a $2,900 fine annually, or $241.67 minus the first 30 employees. Now, this is called the nuclear penalty because simply by missing that 5% population, even if you're offering coverage, if one employee, full-time employee, goes to the marketplace and gets a subsidy, it will elicit this penalty. And if you are an employer that's part of a controlled group of companies, the minus 30 employees must be shared. You can't, not each company gets minus 30. So 1094C Part 1, and again, remember, we're filing it electronically, so you won't be putting this on an actual form, though your electronic filing system will be able to give you copies of these forms. Line 18, you want to do your 1095s first because you have to tell the IRS how many of them you're sending. In line 19, every company has to have what we call an authoritative transmittal. So if you're a company and you have two divisions of the same company, one division is going to file the authoritative transmittal for everybody. If you're part of a controlled group and you have different entities with different EINs, each entity is going to submit the authoritative transmittal. So 1094C Part 2, this always sounds a little confusing. You've got two offer methods. You have one which is called a qualifying offer method and the 98% offer method. These are two ways to file your 1095Cs, and the IRS grants you what they consider a present for doing that. So they give you a break on some of the reporting if you can qualify for each or either of these methods. So the qualifying offer method, a lot of times people think, well, yes, we are, following the ACA, so our offer qualifies. That's not what the qualifying offer method means. What it means is the self-only coverage that you offer to your employees is either equal to or less than the federal poverty level for the year. So for 2025, it was $117.64. You also have to offer coverage to the entire family. Under the ACA, a spouse is not considered a dependent, and you can carve them out in certain instances. So this offer is strictly based if you are offering coverage at or below the federal poverty level. And what do you get for that? Well, you don't have to complete line 15, which shows the self-only cost on the 1095C, because the offer is quote unquote so affordable. The 98% offer method, now I imagine most employers would qualify for this. This means if you offer coverage and it's affordable and minimum value to 98% of your employees, then you can use the 98% offer method. Now, this was created to encourage entities to offer coverage to part-time employees too. But really, if you have your full-time employees that you're offering coverage to, and it's affordable to 100% of them, you should be able to use the 98% offer method. Unlike the qualifying offer method, the 98% offer method does not require you to offer coverage to the spouse. Next slide. So if you're using the 98% offer method, just like under the qualifying offer method, you get a little present. And in this case, it's column B on the 1094C. You don't have to fill out who is full-time in that column. You can leave that column blank. You do have to file all the other columns though. And so that's the benefit of the 98% offer method. So let's go and look a little farther into the 1094C Part 3 and Part 4. This, in my humble opinion, is where I see 90% of problems when employers file, and then they get a letter 2 years later, and they wonder why did that happen? How did that happen? Well, first of all, this is a very confusing question. But what it says is, if you offer minimum essential coverage or minimum value coverage to 95% of employees and dependents, you want to answer yes. So I imagine everyone on the call does offer minimum value coverage to 100% of its full-time employees. So you want to check yes. If you check no, if one employee goes to the marketplace and gets a subsidy, then you will trigger that A nuclear penalty. Now you will have to put no if you're not meeting the requirement, but 99.9 times out of 100, the employer is, and their payroll provider or they didn't recognize the importance of that question, and so they left it blank. The full-time employee count, which I just went over for the 98% offer method, as long it doesn't apply if you're using that method. Otherwise, you do have to put your full-time employees each month. Those are employees that you consider full-time based on the monthly measurement method or the look-back method. So those are your what we call accessible employees. And then the next box, we're going to go to total employees. So total employees is everybody you hired in that month in that company. Can include seasonal, part-time, variable hour, and you can use the first day of the month, the last day of the month, the 12th day of the month, and you can even use the first payroll period or the last payroll period, as long as everything falls in that calendar month to do your count. I would say it's probably simplest to do it on the first day of the month or the last day of the month. And so while we're looking at this slide, you might say, well, why do we need to put in the total employee count if we're really only talking about full-time employees? And the reason is, if you say, let's say you have your full-time employee count like 20, but your total employee count is like 300, that is a flag to the IRS that, wait a minute, maybe they're not listing their employees properly. Who has 300 part-time or seasonal people versus 20 full-time people? So that's one of the ways they look at the form to see what's going on and if they want to investigate further. Last, this is called the aggregated group indicator. This only applies if you were a member of a controlled group, or what we call an aggregated ALE group in one or more months in the year. If you did check that you were part of an ALE group, then you list the other members on your 1094C, and they will do the same. So let's go into 4980H, the B penalty, and that's reflected by the 1095C. So the B penalty is the one you probably hear more about. We call it the unaffordable penalty, because if you offer coverage that's not affordable, so that would be based on the Box 1 W-2, the federal poverty level, or rate of pay. So if it's not affordable and it's not of minimum value, if you have a full-time employee go to the marketplace, then the employer can receive a penalty. That penalty letter is going to come approximately 2 years after you did this filing. So the penalty is $43.50 per full-time employee who receives a subsidy, or $362.50 a month. And again, that assessment is entity by entity within a controlled group. So this is the one that most employers look at and want to make sure it's affordable. Because if you are offering coverage, you're probably offering it to 100% of your employees. But if it's not affordable, that's where the risk comes in. And remember, if it's not affordable, if the employee accepted the coverage, then there's no penalty. The penalty is only triggered if an employee full-time goes to the marketplace and gets a subsidy because your offer wasn't affordable or not of minimum value. So let's look at the 1095C for a second. Here's part one. Again, we're going to be filing all of this electronically. So what I'm showing you is how the e-filing will coordinate with this tax form. The 1095C applies to an employee who was full-time 1 or more months during the calendar year. So for your employees that are ongoing, have been there for years, it's going to be a lot simpler to complete that information than people who come and go during the year, because you have to put in codes for the entire calendar year. The Part 2 fields, the plan start month is required now. So if your plan starts in January, it's 01. If it starts in December, it's 12. If you have more than one plan year, you can put the earliest date of the plan year. And if there is no health plan, you could use 00, though I know you're on the line because you are offering affordable minimum value coverage. The next two only apply if you as an employer have an ICRA, an individual HRA. That would be the employee's age as of January 1st and the zip code on line 17. Now that zip code, depending on the safe harbor the employer is using, could be the employee's zip code, the primary site of employment, or the work location where this individual works. But those are only related to the ICRA. So you can see them, I've colored them all here. So employee age, January 1, zip code, line 17. So if you're not offering an ICRA, the only one you would really want to look at is your plan start month. So let's go through the codes. The most important thing is line 14 can never be left blank. There's always a code that applies. You're going to enter the line 14 code. You can do it and check the all 12 months box if that works, or you use whatever months they were working for you as a full-time employee. Now, an offer of coverage must be valid for the entire month, and that's important because I'm going to show you an example of where an individual left mid-month. And if you use 1F, that means you're offering minimum essential coverage and you're not eligible to put a safe harbor code on line 16. So here are offer codes. I bolded the ones that we really see most often. 1A is a qualifying offer, and remember, that's based on the federal poverty level, not that it qualifies under ACA. So if your self-only coverage is more than that 117, you can't use the qualifying offer. 1C, you might only be offering employee plus dependents because spouse are not covered. And 1E, family, employee, spouse, and dependents. So those are the three we see most. If you have a self-insured health plan and someone was on COBRA and they weren't there the entire year, you could use 1G as relates to that. These are the ICRA codes, and I'm not going to go through each one, but basically they're taking the affordability based on where the employee lives, the zip code of the site of employment, or the employer's zip code. So it's a lot of codes there, but you're really only, if you have an ICRA, you're really only going to choose one. And so I wanted to show you a sample of how this looks like in the real world. Now, if you're using your payroll company, they're probably providing you a little different spreadsheet. But let's say you want to do it yourself, which I do not recommend. I recommend you use your payroll provider or a TPA who provides this service. But you can see it has all of the line 14 codes there. So the first one is showing you would check that if the individual worked for you all 12 months, and then otherwise you would put it in the months that they were employed. So when you do it yourself, it's a huge, massive spreadsheet. And again, I would recommend that you use your payroll provider. So let's look at line 15. This is the employee monthly cost for the lowest cost plan. Line 15, you do leave line 15 blank if your offer code is 1A, and that's based on the federal poverty level. So remember, you leave line 15 blank because in the eyes of the IRS, you're offering such an affordable plan, you don't need to tell us how much your employees have to pay for it. If the contribution is the same for the entire calendar year, use the all 12 months box. So that would really apply if you have a calendar year plan. If you have a non-calendar year plan, generally costs can change from year to year. So let's say you have January through May and it's $100, and June, your plan renews June 1, June through December, it's $150. So you're going to have to put in that cost each month. If you have an age-rated premium for the employees, that's going to be listed per employee per class. So if you happen to have age-rated premiums, it's a little bit more work than just the composite premium. Line 16, these are your affordability safe harbors, and these are so important as line 14, because line 16 is going to explain line 14. For example, 1H means I wasn't offered coverage. Maybe I wasn't an employee that month, 2A, or I was in a waiting period, 2D, or I changed to not a full-time employee, or I terminated before the last day of the month. Because remember, your offer has to be valid for the entire month. 2C, I enrolled in coverage. 2F, the W-2 affordability safe harbor, and 2G, the federal poverty level safe harbor, and 2H, the rate of pay affordability safe harbor. Please, please, please make sure your payroll company or TPA completes line 16 unless it truly is not affordable and you can't use any safe harbor code. So there are really only a couple codes you're going to use over and over. So I create a slide for your 1H codes. That means you're not offering coverage. That's on line 14. And what is your line 16 code going to be? Well, 1H, no offer. It could be applied as 2D because these are people in a waiting period. It could be a 2B because they're part-time, but we usually see it if the employee terminated before the end of the month and was not enrolled. 2A is if the employee was not employed any day in that month. So the month an employee terminates, it should be a 2B. 2A applies the next month because they're not employed on any date that month. So your Series 1 codes, line 14, with your Series 2 codes, line 16. So that can be, 1A, 1E, generally. 2C means the individual enrolled, and that trumps every other code. But if the individual is not enrolled, again, there's no line for waiving coverage because the IRS is not looking, saying, oh, well, Corbin waived coverage, no big deal. They want to know, was it affordable to me? And so if you based your affordability based on box 1 W-2, that's 2F. If you based it on the federal poverty level, it's 2G. If you based it on the rate of pay, it's 2H. I'd like to give you a bit of information that the rate of pay safe harbor is totaled according to 130 hours, not what they actually work. So if they're working 40 hours a week, you still have to take the pay rate times 130 hours. So let's go through a couple of samples. You can see part 1 is simple. We have Maggie here. We have Maggie's employer. She was employed all year long and she was enrolled all year long, and you can see it. So Maggie was offered full family coverage, 1E. The cost of the coverage was the same, $200. And 2C, she enrolled for the entire year. So it's relatively simple. If you're giving the payroll information to your provider, sometimes what I tell people to do is take the people that had coverage all year long first, and then the ones that waived coverage all year long first, because those are going to be the easiest ones to do. So here we have an example where Maggie did not enroll for the entire year. So you can see she was offered coverage, family coverage, 1E. The self-only cost was $200, but Maggie did not take the coverage. And we know that because she has a 2F, which means it was affordable based upon her box 1 W-2. Now, here's one where we're kind of going through the life cycle of Maggie. So Maggie you can't use the all 12 months box anymore because she was not enrolled nor an employee for the entire year. So January, 1H, 2A, because she wasn't employed in January. That's what that code tells me. February, she's in a waiting period, so it's 1H, and it should be 2D. I often see a 2B, meaning they're part-time. No, if they're full-time and in a waiting period, it should be a 2D. So March, you can see she's offered coverage. It's $200 at $200 for the lowest self-only cost. We don't know what Maggie enrolled in because the employer is only required to put the lowest self-only cost. Maggie enrolled because you can see 2C, so she was enrolled March, April, and May. Now in June, she terminated, and I can tell she terminated before the end of the month because it's a 2B code. So remember, your offer has to be for the entire year. So the IRS is saying Maggie wasn't an employee for the entire month. So she's not assessable for any penalty. Then once Maggie has not an employee anymore for the full month, so January through December, you can see you've used the 2A code. So there's only a couple of codes that you'll be using, and I like to say it tells the story of that employee. If you are self-insured and an applicable large employer, there is one part that you have to complete, which is covered individuals. This is only if you're self-insured for all or part of the calendar year. So in this case, Margaret and her husband, Jonathan, they were covered all 12 months. Then they had a baby, and the baby was born in October. So the baby was covered October, November, and December. Also, please note, the date of birth is not put in because if you have the Social Security number or taxpayer identification number, it would be incredibly rare not to have their social or TIN, but that is not a mandatory field. It's only if you don't have their social or their taxpayer ID number. With that, I have actually gone through the presentation really quickly. We've had this law for a while, so I know most people know or are very familiar with the reporting. I'd like to open it up to questions. If anyone has a question, you can type it in the box. I'm gonna stop sharing my screen. Let's see. I don't see any questions. I thank you all so much for attending. We will be posting this webinar on our town benefits site and of course sending out the slides to everyone who registers. It's a privilege to work and serve for each of you. So thank you so much and have a good day. Oh wait, about, what does that say? Would I just ask? Oh, it says, would I just ask my payroll company about the 1095-C? So the way the payroll providers work is they will provide your 1095-C. There's usually a separate charge for it, but I imagine you already have that set up with your payroll company to do the 1095-C. If you don't, I would coordinate with them so that you could do it. There are some self-serve options on the internet for the 1095-C, but I don't recommend it. Again, thank you all so much. Have a wonderful day. Bye-bye.